Welcome to the Infinite Wealth Podcast. I'm Cameron Christensen along with our co-host Anthony Faso. We just wrapped up our second interview with Aaron Chapman from Security National Mortgage. What are your thoughts, Anthony?
Well, I would tell you, I'm going to share a highlight and a low light. Okay. Right? The low light is I actually referred to Aaron as a mortgage guy. And then Cameron right in front of him corrected me. Well, he's more than a mortgage guy. He's blah, blah, blah on this. And so he made me feel like that small.
And that was the highlight?
No, that was a low light. Oh, but that's why we had Aaron on again for the second time, because he's more than just a mortgage guy. And a lot of time right now, there's a lot of talk about should I refinance because the mortgage rates are so low. And I've been following Aaron for a long time, and he's the only, I don't know if I'm calling him mortgage guy now because he's not here. But
sorry, Aaron.
He's the only mortgage guy that I've ever seen that is not a fan of refi. So we're like, we need to get him back on the show to explain and why he's not a big fan of refi. And we ended up getting so much more. There was a lesson in economics, and man, it was a very good podcast. What was your highlight?
It was great. I would tell listeners, man, just sit back and enjoy this episode because there is so much information. But one thing I will say is in here, Aaron is going to actually share his screen and he's going to go over some numbers with us. If there's one podcast that you go through and make sure that you watch the video on YouTube, this would be the one. So go to our website, check it out. We'll have the link in there because what he does is he goes through and gives us an example with actual numbers of why real estate is one of the best vehicles as a hedge against inflation. And you've got to see it to believe it. I've always heard that conversation, but I don't know if I've ever seen anybody go into such detail as Aaron does. So really, really good information. Again, that's why we brought him back, and hope you guys enjoy it.
Enjoy the episode.
Take care. All right. Aaron Chapman, welcome back. We're so happy to have you. We brought you back because, as Anthony mentioned off air, is the first episode that we had you on is absolutely one of our best performing podcasts. We've got a ton of downloads and a ton of really good feedback on it. And so, man, we had to bring you back, right? So thanks for joining us.
Well, what's really interesting, it's one thing to get on the podcast. It's a whole other thing to come back, right? So
that is true.
That happen and saying, that redneck's not such a bad dude. So thank you. And thank you to all the people who listened and who had made that one of those good performing podcasts. I want to be able to give the best data I can, and you never know until you get the response. So thank you both.
Absolutely. So we've got some big questions here, but can you start and just kind of give us maybe an overview of kind of the current environment as far as interest rates and what's driving that market right now?
So yeah, that is very interesting scenario itself. In fact, that may also lead to a little bit of a screen share here. And I know there's a lot of people that are not able to see this, but I'm gonna share with you a chart. Because a lot of times folks are asking, what's driving rates? The Fed just lowered the rate, and we look at the 10-year Treasury and it's doing X. So why is your interest rate here? Well, too often people don't realize that, and I'm disabled so far on the screen share, but I've got a chart that I follow every single day. I'm able to watch and see what goes on with the actual trading. I can see how much money, not exactly the dollar amount that's available to lend, but where the trading's coming from that drives the interest rate. So this is what you're going to see here is the mortgage-backed securities pools. This is actually, have you guys ever seen The Big Short?
Yeah.
Oh, yeah.
Absolutely.
Okay, remember the meeting with Lou Ranieri and that not hedge fund. He was a pension fund manager, and they're sitting in that conference room with the overhead projector that all the houses with the circle around it. And the famous quote in that is, "Who the hell doesn't pay their mortgage?" Well, that was describing the foundation of the mortgage-backed security, because up to that point, you had banks would take people's deposit capital and they would lend it out to the community, right? And they'd get a return on that through interest, and they'd pay their depositors a certain amount of interest for having their checking account, savings accounts, and CDs. Well, the reason CDs were basically in a way created, and I don't have this is, one of the ways they used it is I don't have 100% all the reasons why they created the CD, but that was a locked in period of time that the bank could use that money and know it's not going anywhere, so they could make money with it. So back then, you had banks being able to charge, 12, 13, 14, 15, 20% to borrow money for a house. Well, Lou Ranieri at Solomon Brothers got this, and he's like, we can make this on a global scale. So they met with these pension fund managers, and they created the mortgage-backed securities. So what you're seeing right here is the last 2 years of trading. Every single one of these little bars represents 1 day of trading. Well, we get here, which is March 9th. That's when everything changed. Our whole world changed on March 9th when it comes to economically. And when you're seeing all this decline here, that was when the stock market completely freaked out with this whole COVID thing or whatever. Now, you can't see all of it when I zoomed in here for the last 3 months. But what it shows is the mortgage-backed securities was still a solid place to be because they wouldn't have the foreclosure issues from the past. We didn't have people that owned houses that couldn't afford them like we did in the past. The underwriting was better. But banks were leveraged in a big way in the markets that were susceptible to the movement of COVID influence and all that. So because of that, they had margin calls. So if banks had a ton of money on deposit, right, they're not going to leave that money in the vault. They're going to put it somewhere. Mm-hmm. So let's say they put a bunch of it into stocks. Well, we know what the stock market did on March 9th, right around March 9th area. Well, then you had margin calls coming like crazy. Well, because of that, they had to unload some of their assets. Part of their assets were mortgage-backed securities. So you can see that major sell-off here on this chart. Well, that major sell-off, they were selling those assets to get enough capital to make these margin calls. Well, then you had the Fed step in and say, because they need to borrow from each other, and they couldn't because everybody had these problems. So the Fed then drops the overnight window rate to 0. That's when everybody starts calling me and saying, why is my interest rate not 0? Well, I had to explain to them why. So I started a YouTube channel basically that goes over this twice a week, what's going on in the market and why. What we have here is you see this decline. The Fed finally stepped in and said, we're going to allocate capital for this. And the Fed started buying mortgage-backed securities starting on March 20th, all the way up until March 30th, they were dumping money in there. So if we go backwards to 2008 and 9, they started quantitative easing in 2009, which is the Fed buying treasuries and mortgage-backed securities and all that. Now, between January 1 to the end of March 2010, so January 1, 2009, end of March 2010, 1 year and 3 months, they put in $1.25 trillion. Huge amount of money, right? Look at right here. This movement right here is equal to over $1 trillion invested in 10 days by the Fed. Huge quantitative easing going on here. Well, they were going to continue to keep pumping money in there. And then there was a guy by the name of Barry Habib out there that has that used to have a show on Squawk Box for like 13 years, very heavily invested in understanding mortgage-backed securities and instructing the lending world about it. So what he did is he got a hold of these guys through his sources and told them, listen, you need to taper off of this because you're going to cause a bigger problem, which they did. It actually created a problem already with the servicing side of the industry. As rates went down, people were refinancing at a massive rate. In fact, at that time, it was displayed to us, that the mortgage industry had a demand of nearly, if I'm going off of memory here, I got to go back and look at my notes, but nearly $5 trillion in demand at that point. The mortgage industry is only structured in a way to handle $2 trillion in demand per year. We had almost $5 trillion just up to that point, just in 2020. So you can see how incessant the refinance demand was by the average consumer. So what happens here, you look at the unintended consequences of all this refinance demand. So what Barry was telling the Fed was that you need to taper back your buying and you ease up. The reason being is the servicing side of the industry is going to have a problem. And what that is, if you guys ever done a mortgage on your house or an investment property, and then within a month you're getting a letter that you're saying that you're going to pay somebody else.
Yeah.
People always ask me, do you guys sell your loans? We don't sell the loans per se because the loans already belongs to this pool, already belongs to Wall Street. They funded it. We're just servicing it. When you sell the servicing, is somebody's paying the owner of the loan, this pool, whoever funded it, 1% of the loan amount to have the servicing rights. They get to own the rights to collect. And then they have to manage the collection. They got to pay the taxes and the insurance. Where they benefit from that is they get to keep what they call as 30 basis points for that. So let's say it's a $100,000 loan. We're going to do a lot of math together today on $100,000. So let's say you closed on a $100,000 loan. The next servicing company paid $1,000 for that, 1%. But they get to keep $300 a year of what they collect as their compensation. Well, it takes about 4 years to break even when you consider what they paid for it and their overhead and all their expenses to maintain that deal. They got to do a lot of loans. But we saw in this window in the last little while that people were not keeping the loans longer than 1 or 2 years. What happens to a company that puts up that much capital, but yet gets paid off within 2 years? Where's their break-even point? It's completely shattered, right? They're losing tens of billions of dollars a month as a result of this. So what happened there, right around this point of March, actually it was mid-March when really this started to happen, and then we were able to convey to the Fed at the end of March why he needed to back off, is that the servicing companies told Wall Street and said, "Want something, guys? We're no longer buying your crap. No more. We're not paying you 1% for your loans. In fact, we know you can't service it, so you're going to give them to us. And after you give them to us, you're going to give us a $500 check." So it went from $1,000 being paid by the servicing companies to now $500 being received by the servicing companies. So you see a $1,500 swing there for a $100,000 deal. When you're talking about blocks of tens of billions of dollars, you can look at the amount of money that was trading hands right there. Massive, massive swing. So one, we got the Fed to calm down because Barry and his team reached out and got him like, oh, wait a minute, now I understand. So if we look here, look at how flat we've been this whole time. So they had to taper back a little bit, and they got it within this channel. Each one of these days represents back here somewhere in the range of about 8 to $10 billion a day being invested by the Fed. We move along here, we're still in the range of about $4 billion a day being invested by the Fed into the mortgage-backed securities. Now, when you look at that on a monthly basis, on an annual basis, that is an insane amount of money being invested by the Federal Reserve into the mortgage-backed securities pools to keep the interest rates low. So our interest rates right now, not only are they kept low by the Fed's the main investor in that now, right? Well, then you have the servicing company saying, you got to pay us to take it. So the common loan, we were talking about, like, say, a 20% down investment purchase for a single family, they're still really good rates in the mid fours, but they're charging points now because they have to pay the servicing side of the industry, where they used to be able to get fed some money from the servicing side. Now they got to feed them. There's a swing. So many of my clients would ask me, well, why don't you just raise the rate and pay it yourself? Well, we're back in the same problem, right? If you bump the rates up into the fives and then the rates go down, everybody refis again, and they continue to perpetuate the cycle. So there was a bit of I guess a huddle somewhere where they figured out, wait a minute, we keep the rates low, we charge a point, they get the low rate, so it's going to be harder for them to refi later, and they paid more money, so it would need to make more sense to refinance. So then you get into, some people putting more money down, the 25% down on the single family stuff, the 30% down on the single family stuff. That actually, those particular types of deals, they're offering lower rates with less cost. You're not going to pay those points for that. And the reason being is because they found from what I understand, this is just what I'm gathering as I'm looking at it, when they look back in the history of those, they perform with less refinance when you have more money injected into it. Why? Because people are refinancing for rate, right? When you're refinancing for rate and your balance is really low, it's really hard to see a huge benefit. So that's why I've been preaching up and down sideways to the entire refinancing world, especially investors. You don't refinance unless it's for cash out. Because in reality, we're never paying the rate anyway. So, in fact, I got another screen share to even prove that point. So when we're talking about refinancing for rate, you're going to pay a certain amount of money at today's cost to get that so-called benefit on the rate, right? That benefit of the rate is going to give you a little bit of a lower payment, therefore a little bit more cash flow, yada, yada, yada. But we live in an inflationary environment, right? Mm-hmm. You guys know what today's rate of inflation truly is, not the CPI or the PCE, real rate of inflation.
Probably 6 to 7.
I'd say 4 to 5.
6 to 7 wins it. I mean, and it's Price is Right rules too, because it's like 7.4. So you closest without going over. So if you guys ever follow John Williams' Shadow Stats?
Yeah.
Okay, so he has his alternate data, and that's what he's showing. It's right there in the mid sevens right now. So I use 7%. I've been using 7% for a couple of years now, even though Williams was saying is between 9 and 10 for the last few years. And that's national inflation. And the reason, there's going to be a lot of people scratching their head saying, well, the Fed quotes consumer price index, and we're consumers, or the personal consumption expenditures, and we're personally consuming. Why is the Fed wrong? Well, they're only measuring certain things, specific items that doesn't really change. But when you look at the cost of living as far as actual food costs, actual energy costs, the toilet paper index, for crap's sake, you start to really see where things are going, right? Expenses going higher. Think about the young couple who just had two kids. Where's their expenses going? I just have a friend of mine. They're my age, mid-40s, and his wife's pregnant with twins. Unfortunately, she also has a massive medical issue going on that they're having to go take that on. So now they have massive expense medically plus twins. Can you imagine what their expenses just did? So when you start really factoring in the rate of inflation for the average American, 7%, pretty weak as far as I'm concerned. You get into the Bay Area is 13% for the last few years.
Dang.
So what I'm showing here is a tool. We're taking the annual inflation number of 7%. We're going to get back that $100,000 price or value of the property with an $80,000 loan. And the interest rate, I'm just going to throw in 4.5. We don't know until we talk to each person what rate they will have, what the market's doing, what their credit score is, all that kind of stuff. So I'm just using this for the purpose of our communication. And we're going to factor in a 1% rent to value of $1,000 a month. And we're going to factor in a $200 a month cash flow. Do those seem unreasonable numbers?
No.
Not at all. Okay. So we're looking at this 4.5% for 30 years, starting at the end of this month. You're going to pay off in 30 years on an $80,000 loan. That means you're paying back a principal of $80,000 plus interest that accumulates over that 30 years of $65,925.37.
Okay.
We are agreeing that $405.35 a month payment is equal to $145,925.37. We all agree?
Correct.
Yep.
So that's the principal and interest over 30 years. Now, Einstein's the one who said that compound interest is the eighth wonder of the world, right?
Yeah.
Those who understand it are going to earn from it. Those who don't understand it are destined to pay it. Well, one thing Einstein didn't have at his disposal was a long-term instrument in an inflationary environment like a 30-year fixed mortgage. So you take a 30-year fixed mortgage and we factor in that the dollar's buying power will decline by 7% annually. Interestingly enough, never go to zero, though. It's a dynamic that's kind of hard to wrap your head around. But a 7% decline in its buying power, you recalculate every dollar's value when you make a payment on that loan for the next 30 years, compare it to the value of the dollar the day you borrowed the 80,000, is no longer paying the 80 grand back or the $65,000 in interest. It's worth $60,926.91. You're literally earning because you're paying it slow. This is Aesop's tortoise and the hare kicking ass at its best.
Okay. Very powerful, Aaron. Would you mind summarizing that? Kind of like, particularly the numbers, because we have a lot of people that may not be able to see it.
Yes, and that's the thing. That's difficult if you're not looking at it. If you're driving down the freeway right now, especially in California, getting pissed off with the other drivers.
Yeah.
You gotta wrap your head around that. So when you think about where the dollar stretches, right? Where its value is, especially the last 30 years. I guess the easiest way to say it is that since it's worth less and less every time. But let's just do this exercise, really kind of break it down a little bit better, is since we're investors and we have renters, we get to raise rents to pace inflation, correct?
Mm-hmm. Correct, yep.
You know what the average rental increase is in the apartment world right now nationally?
3? 4?
Balls on
3.1?
6, right?
What?
So let's just use 3 as a number, right? Okay. So we're going to do some math together again. Hopefully this helps illustrate it mentally to those listening. So if you've got $1,000 a month rent, right, on this $100,000 property,
mm-hmm.
we get to raise the rents by 3% per year, right? What is 3% of 1,000?
$30.
$30. Nothing sexy, right? But first year you got $200 a month in cash flow. Now, second year, it's conceivable that you get $230, depending upon what may have changed with taxes or insurance. So let's just say it's $230, right?
Mm-hmm.
So we got to raise that rent by $30. Now, if you divide the $30 into 200, what percentage did your cash flow go up by?
Tell us.
15%.
Okay, I see where you're going. Okay.
Every time you raise rents, that 3%, so it's 3% of the current rent. So if it went from 1,000 to 1,030, now it's 3% of 1,030, right? So you're getting a compound growth on that. 3% compound growth, which is equal to 15% on your cash flow. Now you see how huge this is. Then you go to the fact that you're never even paying it back, because the dollars that you're giving it back with, that you're able to continue to increase as a landlord, because we're pacing inflation. If you look at the charts, rents have always continued to go up, right? There's a small window of time between 12 and 13. They kind of flatlined, but they've gone up to pace inflation. But inflation has eroded the dollar's value every year, and that's why you can raise rents. But the person who gave you the money, the pension fund who put that capital up for you, says we'll accept the same dollar amount, the same $400 and $405.35 for the next 30 years, regardless of what the value of the dollar is. You get to see the spread. You're raising your rents and increasing your income as you're paying them back with something that's worth less and less and less. And if you take the time to do the math, you will see that $80,000 becomes worth $60,000 in 30 years, even when you add the interest of $65,000 to it. So, in fact, Shadow Stats actually has let me see if I've got it up somewhere. I don't.
Aaron, while you're pulling that up, I've kind of been paraphrasing the famous line from Dazed and Confused. I told you this before, Cameron, but it's kind of, I think Matthew McConaughey, or somebody makes a comment about dating, but
I know what you're talking about.
You know, the reason why,
I get older, but the college girls stay the same age.
Yeah, and where I kind of relate to this in regards to renting, you get to raise your rent, but your mortgage stays the same.
Exactly. So what we're going to do is we're going to go backwards 30 years here.
Aaron, do you have a title for that concept right there? Man, I think you should name it.
Of compound interest with inflation. That's kind of the best thing I can say. I don't have a title for that, but what that was the podcast I had done probably 2 years ago, maybe more. And the professor of accounting at Kennesaw State University called me up and said, listen, I heard what you were saying. And he goes, that's exactly what I'm trying to preach, but nobody preached it in the way you just said it. So they built that tool for me. That's not my construction. That was the accounting department at a university built that tool for me. So now we're in partners to build an app around it, and the app's almost done.
Awesome. What came to mind there was what you just touched on is one of those, it's always kind of been an intangible, right? No, I've never seen anybody really assign any numbers to it. People understand cash on cash when you're talking about investments and returns and those things. But the piece that you just touched on is very powerful that I have not heard many people ever discuss, or let alone illustrate the way you did. So thank you.
Well, I've seen people discuss, everybody says it's a hedge against inflation, but nobody's ever put an actual dollar amount or a number to it. So from what I know of, I'm the first guy to put a number to it because I collaborated with smarter people than myself. But one of the other things people don't put a number to is let's talk really briefly. Well, before we get into that one, let me just share the Shadow Stats number here real quick. Look here. I mean, this was $100 in today's value. You could purchase the same amount of stuff in 1980 with $4.80.
Dang.
Wow.
Think about that. So that illustrates exactly how much we're dealing with here. So in fact, if we flip it around, we'll go to 1980 here. You have to be a subscriber to Shadow Stats, and it's easy to get on there and into their alternate data stuff. I just tell people just to get on there and understand it. And we flip this around. That means in 1980, $100, it would take $2,082 today to get the value of $100 from 1980. 30 years, guys, that's what happens here. So when you understand that concept alone, leveraging high, leveraging long, and paying off slow starts to make sense. I do my best to stop people from taking their cash flow to pay down their mortgage. Quit that. That's your money. Keep that money and put it somewhere else. Do not use that to accelerate your loan when somebody else is willing to sit on that much capital for 30 years for you. So that's probably, you want a summary of the concept: leverage high, leverage long, pay off slow. That's a summary of the concept. And now I have the proof as to why you want to do it from sources, not just Aaron Chapman. This was Aaron Chapman's theory that's proven from a whole bunch of other different directions.
You know what? As you're saying that, and I know, Aaron, that you do practice infinite banking, and I know that you have these policy loans. Wouldn't you create the same isn't it the same thing of a mortgage and compared to a policy loan of being able to pay that back with the weaker dollars?
Well, the thing about the policy loan, I don't mind paying the policy loan off faster because it's my money, right? Because all that does, the faster I put that back there, the faster I can redeploy it into another asset. But if I let it sit there in one asset for a long period of time, yeah, it's still going to work. But my preference is to take all the cash flows that I get from leveraging with mortgages across there, take all these extra cash flows plus 10% of my income and knock that policy loan down as fast as possible. And the beauty of it is I can take it out whenever. I don't have to wait till I pay all of it off. I knock down 30,000, pull that 30 grand and redeploy it. Do it again, pull it and redeploy it. So just keep putting money back into the policy loan. So it's one thing if it's yours, it's a whole other thing if it's somebody else's. Because when it's somebody else's, they're willing to accept fractions of their dollar back over 30 years. Why would I do that to myself?
Yeah.
Take advantage of the situation, let them create cash flow so you can keep running it through your policy and build wealth that you're not even really having it. You don't notice the difference. You feel like it just feel like you're setting 10% aside, but in reality, you're expanding wealth exponentially.
You mentioned,
go ahead.
Sorry to cut you off, Aaron, you mentioned something, you made a statement right before you jumped into the conversation about hedge against inflation, is you said, I wrote it down, is we're not paying the rate back anyways. Can you explain what that means? I think I know what you mean, but I'd love our listeners to hear it from you.
Well, getting back to the charts, right, that tool, you can see that even though we borrowed 80,000, and even though the interest was 65,000 and change, the actual amount of money, the real value of the money that left your hands was only 60,000 bucks. So you're never even paying back the 80,000 right there. You're not even reaching the amount of interest that, when you look at the value of the instrument you're paying it back with versus the stack of $1 bills. When you equated the real value of those $1 bills 30 years from now, you're paying less than what you committed to pay back to them.
You know, I do want to remind the listeners that Aaron has been sharing his screen. We are recording the video, so just try to enjoy and follow along. And in the link in the show, we have a link in the show notes where you could go to the video, and then you can kind of see what it is we're talking about. Thanks
for explaining that question or that statement you made. I had assumed in my head that what you meant by it, or my understanding was that as an investor, we're not paying it back anyways. Our tenants are.
Exactly. The tenants are covering, and then you get to write off on your taxes if you did.
Exactly.
That's the other beautiful thing. I got a whole other thing to explain now, so I'll get into that one in a second. Let's go backwards just a little bit where I started ahead before I showed the shadow stats graphs here. But ultimately, let's look at another thing that people fail to realize where they're making a massive return. Too often people get caught up in what's my cash on cash return, what is my cap rate and all those things, which are great metrics, but they're really, really quick metrics. That's when you're flying by at Mach 2 at 30,000 feet. That's what that is. That's just a quick view of it. You dig into the depth of it. We'll go back to that $100,000 purchase, 20% down, $80,000 loan, right? So if you did your job as the CEO of your real estate investment firm and bought with the right people, bought the right asset, and have the right people managing it, keeping it reasonably rented for the entire time you own it, who's paying back the $80,000?
The tenant.
The tenant, right? So it's their money starting it, and you're filtering through you, and you're taking your piece, right? It's kind of like that servicing model we talked about earlier for the servicing part of the mortgage industry. So since they're the one paying it back, right? Let's take that $80,000 and it's divided by 30, because that's how many years it's going to take for them to pay it back, right? Okay. So what do you guys have calculators?
I knew that you were going to ask us to calculate that, but so it was 80,000.
It was 80,000 divided by 30, because that's how many years it's going to take your tenant to pay it back for you.
Okay, that's $2,667 a year.
So yeah, so it's, if you get down to the real pennies, it's $2,666.66, and the six keeps going, right? So so you're right on there. So you take that, you divide that into the 20,000 that you put down, because that was your investment. You invested your 20 grand. Mm-hmm. Your tenant's paying off $2,666.66 per year. How much is your 20,000 growing per year of the original 20,000?
13%.
13.33333% is what that growth is. So you're taking your 20 grand, you're adding 13.33% of the original 20 grand every single year. What other vehicle is doing that for you?
None that I'm aware of.
That's just in the amortization of the loan. You're literally, I would say you are justified when you discover this to climb on your roof, drop your pants, and show the whole neighborhood how big your balls are. You're getting 13.33% gain on your 20 grand every single year just by parking somebody in there. That's not even cash flow. We're not looking at cash flow. We're not looking at cap rates. We're not looking at anything else but just
appreciation
off the loan. Not even appreciation. Exactly. How amazing is that number? People get excited about that. And then you get into what we just talked about, never even paying off the loan, right? And you get a 15% compound increase on your cash flow just by increasing the rents, and then you start factoring the fact that we get tax write-offs for this. So I had a client back in 2017. He was in contract on 2 properties on the same street, same floor plan, same potential rents, same price. There's 2 differences in these properties.
Okay.
The floor plans were flipped. So one had the garage on the left side of the front door, one had a garage on the right side. One was just about done being built. It would be ready to close in less than a month. The other one had yet to break ground, so it was a bare lot. He had a contract on a lot and a plan. We closed on the first one December of 2017, 4.75% interest rate. He was happy with the cash flow, happy with the deal. Well, then Jerome Powell, the new Fed chairman at that time, decided to do quantitative tightening. Are you guys familiar with that term?
Mm-hmm.
Right. So he took his foot off.
You want to explain it to Cameron?
So, so Cameron will play audience for us. So quantitative easing, we talked about 2009 to the end of March 2010 with $1.25 trillion of quantitative easing, right? So then you start seeing they had a consistent $10 to $20 billion a month going from end of March 2010 on through the end of 2017 was being put in by the Fed. That's a stupid amount of money, right? Well, then the Fed chairman says, Jonathan, I think we're in a good spot. We're going to take our foot off the gas and start applying the brake. So they're putting in less and less every month. So by the end of May 2018, only 6 months later, we have now seen them backing off enough that interest rates rose from 4.75 to 5.75 for the exact same deal. So the house was done being built. The client called me up, said, hey, we're ready to rock and roll here. So I quoted his rate. He said that that he was thinking of backing out of the deal. I'm like, why are you backing out? So I'm losing $600 a year on buying number 2. Like, how are you losing $600? So, well, the difference in the payments is $49.97. You round up to 12 months and a little bit on the pennies, that's $600 a year difference between the two with the same amount of money that I've got to spend to get there. So I think I'm going to back out. And I said, well, his first mistake, he was thinking he was spending money. You're not spending money and going into debt, right? This is we had to get him away from that. He's the CEO of a real estate investment firm. He needs to understand there's more ways to make money than cash flow. So I said, okay, as a trusted advisor at your board table, as we talked about up front, let me give you a suggestion. And I would suggest you call your CPA, because it's now May. You finished your taxes last month, right? He goes, yep. Call your CPA and ask him what's the difference in the taxes you will pay the way you're set up on the higher income property number 1 versus the lower income property number 2. Then ask him what's the difference in the tax deduction you get to take on the higher interest rate property number 2 versus the lower interest rate property number 1, and then come back to me. 3 days later, he calls up and says, hey, let's go ahead and close. It's like, why are we closing? Because, well, after the numbers were run, I understand now that I'm not paying $49.97 difference. The difference is about $3.55 per month. Let's go ahead and move forward. So what it boils down to is you're not paying it. We just established that. Your tenant's paying it.
Mm-hmm.
To write off on your taxes if you did. And the way the tax code is written, if you properly structure your business, smooths it out that it doesn't matter what the rate is. And then we figure out the fact that you're never even paying it back because of inflation. There's no reason why a person should not put all their energy into understanding how their business works and start following the best practices to make it deliver like that.
Well, Aaron, that's great. I think we've asked one question so far, but you've actually answered a few, because one of the questions we were going to ask is, we have some clients who say, well, you know what? I don't want a mortgage. I have the cash, so I'm just going to pay this $100,000 in cash, and then that way I'm going to have more cash flow. I know you already answered it in detail, but you want to answer that and maybe in a summary?
Well, ultimately, when you're paying it today's dollar value, you paid today's dollar value. You paid if it was $100,000 purchase, you paid $100,000 for that property. But in reality, if you leveraged it, put up the 20. That 20 is yours that you do put up, but you're only putting out 60,000 of somebody else's money, and you're keeping the spread. So when you think about that, you bought $100,000 property with 20,000. What filtered through your hands was real dollar value of 60,000 for the next 30 years before it was paid off. So when you think about that, that's 80,000 and change. So let's just say 81, let's round up, $81,000 that you deployed, and the majority of it belonged to somebody else. Why would you want to put up 100% of it being yours at today's dollar value?
No, that is great. Not to mention, I mean, because one other theory would be is, okay, if you do get a mortgage, you still have 80 grand to do something else with. And in theory, you could buy you can buy a total of 4 houses, right? And then just like it's just amplifying everything you're talking about by 4, as far as the tax deductions, the depreciation, and all of the other advantages of real estate. And we've actually, and then just to go a little deeper is, just so we talked about before was ideally, we recommend people running that down payment through their policy. But one of the common concerns or pullbacks we get is, well, now I have another payment that I need to pay back the policy loan. But at the end of the day, it's really all about having more cash. And we actually created a video that actually goes through the numbers, comparing you buying a house in cash or buying it with a policy loan, or whether you're maybe that 100 grand, the example is just a down payment on maybe 4 or 5 properties. But at the bottom line, we do the math, and you will have more cash and pay less taxes by running things through the policy. So there will be a link in the show notes to a link on that.
I do 100% of mine through the policy, because I think it's crazy to do it otherwise, because my money sitting in the bank account, we're losing so much money with it sitting in a bank account. I'm still helping my wife wrap her head around that. Running it through the policy, paying it, when they're saying they have another payment to make, they don't have another payment to make. That's your money. Ultimately, what you're doing is you're deploying your capital, and you need to get an engine running. This can become an actual wealth-creating engine for you if you think of it properly. So let's say you pulled that 100,000 out and deployed it over 4 properties, right? Mm-hmm. If you got 4 properties creating $200 a month, right? So now you got $800 a month coming in. You have a $100,000 policy loan. Well, somehow you created that 100,000 to put in the policy to begin with, right? Mm-hmm. Me, 10% of my income every month. So I'm going to take my 10% of my income plus the $800 from those properties, and I'll be dumping that back into paying off the policy loan every single month, right? So let's say a person can put in there a couple $1,000s a month on the regular, right? And keep docking that down. Well, before long, it won't take long before you get this compound going in there, and you become a little bit more cognizant of your spending, become a little bit more aware of where your money's going. And maybe it's like, wait a minute, I can go a little bit higher than 10%. Maybe I go 12, 13, 15%. Keep knocking down that policy loan, because ultimately I know for a fact that the more I knock it down, that's just more money available to me to borrow. So it's not like I have to keep it in a savings account or in the bank. Dump it there, right? Because I can access it anytime. Keep knocking that down, and before long, you have now $30,000 available again. You may have had a $100,000 policy loan with 0 available to you, but not long, it's going to be a $70,000 policy loan with $30,000 available. You yank the 30 grand, buy another asset. It creates 200. So now you went from $800 a month in cash flow to now to $1,000 a month in cash flow. Plus you had your 10% that grew to 13 or 14. Now you're attacking it even faster. So instead of having to wait 6 or 8 months to knock that down, you're now getting we'll have to do the math, and it's longer than 6 or 8 months to get 30 grand. But now you've accelerated that time frame where you're getting your 30,000 faster. And you do it again, it gets faster and faster, toward then you may be able to start buying properties every 2 to 3 months after you get to after you do this 5 or 6 times. So you can see how fast that domino becomes. There is people that talk about using the debt snowball effect to buy real estate by paying one off with all your cash flows and buying another one. with the extra cash flows. If you do it with the policy loan, it accomplishes the exact same thing, but now you're not paying off your leverage, which is where more wealth is being created, as we just illustrated with inflation and all the other things.
Wow. That that was fantastic. And let me just add one thing about paying off a mortgage versus paying off the policy loan. If you start paying off that mortgage, there are some advantages to that, right? But in theory, what they want to do is then they want to do some sort of refi and take the money out, which maybe you could, but people also have to realize that you have to get permission to do that.
Well, and you have to pay for that. It costs you money at today's dollar value to get that. So why would you accelerate your payment just to take it out again later, right? Accelerate your payment on your policy, leave the money in the mortgage. Now, if 5, 6, 7 years from now, the appreciation, which is, I don't play the appreciation game, but let's say you got some appreciation in there. It happened to be in a market that just skyrocketed. You got an extra 40 grand sitting there. Well, it's free money, even though you're paying costs to get the financing on it to refi. It's free money you get to take from it because you're not the one paying it back. And it depends upon where you apply it. But paying it down in an accelerated way just to pay money to get it back out, that's no different than, you've got a trader, or at least a stockbroker that moves your money around like crazy in different stocks so he can get paid to trade. Mm-hmm. You're not making money off of that. You're paying somebody else to trade so he can make money. Because ultimately all mortgages are is a Wall Street trade. So when people are convincing you to refi, they're convincing you to go back into that 5 years of almost all interest during your amortization period is almost all interest, just so they can get paid to do another trade. Don't do that shit. Retain your money. Put it somewhere else. The policy is still yours. So that's why I encourage people, keep doing that. Do your growth over here. Now, if we're looking at it and you reach your 10 Fannie Freddie and we can do a consolidation somewhere or figure out something else, we will help you in some form to structure your business to still take advantage of growth opportunity. But don't sacrifice tomorrow for some sort of crazy crap today.
Aaron, one of the things that a lot of people are doing now, and you even talked about at the beginning, are refinancing. And you are the only, you definitely have a unique perspective on finance, which we agree with you on your stances. But you're the first mortgage guy, if that's a proper way to describe you, who's not a fan or of immediately refining as soon as rates go down. So would you mind sharing your philosophy on that? And I do, and if someone is considering refining, what are some things that they should be looking for?
So, one, you could probably line me up with every mortgage guy and really be able to say you're the only one of every aspect that has to do with mortgage guys. I don't look like those some bitches. I don't talk like some bitches. I don't think like those some bitches. And if I'm ever able to class with them whatsoever, I need to quit the damn industry, because the standard thought process is something I tried to follow and it just felt wrong all through my career. And I remember right out of the gate, the way that they described how you slide things past people, the guy who was training me, I couldn't get behind it. I had to find a better way to do it. But what really sucks about it is you're swimming in a sea full of predators, to just be honest. The humans are the apex predator, and the only real prey that we are to is other humans. That's it, right? And so when you're swimming with sharks, and you start realizing what they're doing, it's like, how do I compete with all these guys that get in these frenzies and start taking business? And if I don't play the same rules, I had to figure out how to do that. And it took me, probably 16 years to really figure that out. But then you have to have a significantly large set of clanking balls to be able to step out there and say, I'm going to do it my way against the entire industry, and then get people to follow me. And they did. But it was not an easy thing to do. And when it comes to the refinance thing, I started to discover that the real where we prey upon people most is in the refi world. Say, hey, the rates just went down, let's refinance you. When I realized that interest rates don't matter at all when you're properly leveraged and you're properly structuring things, that the one thing that I had to do from there was educate everybody on why that is and show them the information that I just showed you. The toughest part of all that is the time constraint that it is to educate people on this. It's extremely taxing mentally, physically, and against time to educate the people that I am working with about why it's not a good idea. Now, if it's your primary residence and you've got $600,000 loan, you can drop a point, and it's going to add a significant decline, $500 difference in your payment. Well, come on, that just makes sense, right? $500 can change a person's lifestyle pretty significantly. And anytime you can drop what your personal outgo is, it's hard for me to argue that. Now, if you're doing it on an investment property, that's where I have the argument here, because when we're talking about the average price point for an investment property, people call me up. I got this. I got a 5 1/8. I want to get it down to that 4 1/8 or 4 1/4. I'm like, it's a $58,000 loan. It's not going to make a difference. $8 a month, and you're going to pay $5,000 in, well, let's say $3,200 in cost between lender, title, appraisal, inspections, or not inspection, but lender, title, appraisal, and all that stuff, and more taxes to do all that work just to save $15. It doesn't make any sense. So when I educate them on that, they start realizing if you're not pulling cash out, you're wasting the cost to do that. So, the reason why I think that is such a prevalent thing in our industry to convince people to refi is, one, when you think about those who own the loans who put that up, if they're not getting paid off, they're not being held out on that payoff for 30 years, and they get paid off within that first 5 years, they get almost the entire principal back at that payoff, and they collected nothing but interest that entire time, right? When you look at the first 5 years of an amortization table, it's almost all interest. If you can convince people to stay refinancing within that first 5 years, and they've done a very good job of it, you're never getting your principal attacked. You are earning interest like crazy. And then the people on Wall Street who are making that trade, they're making their piece, right? And then the bankers who are doing the refinance, they're making their piece in the fees. So when you think about it, this is 100% this is Aaron Chapman's opinion. I may have a bunch of people out front in suits and ties and shit with pitchforks to kick my ass, but this is a predatory practice to get people convinced to refinance. Well, hey man, you're at 4.5 right now, but I get you 3.875. That way, this week when we see that asshole brother-in-law, you tell them, hey, I'm in the threes. What are you at? Right? They're chasing a feeling just like any other sales pitch, and I can't agree with it.
Interesting. No.
Question?
No, Anthony was again dumbfounded, had speechless. Speechless is what he was. I know you got to go. I've got one kind of idea here, one topic that as I was thinking about this or our conversation, I wanted to bring up is the idea that appreciation is the means to financial freedom. What are your thoughts on that?
Well, here's the thing. Appreciation, in my opinion, is very market driven. Well, it's not even my opinion. It's market driven, right? So we're leaving our fate of our future in the hands of everybody else, because you don't individually control the market. Neither one of you. I don't individually control the market. I can't look at appreciation on my balance sheet as something that I got to guarantee, because the market has proven time and time and time again, the second you think you're there, it takes it from you. Talk to anybody who thought that during the dot-com bubble. Talk to anybody right before March of this year. Appreciation is what everybody's trying to follow for their wealth. Take control of the wealth and start looking at all the other ways that real estate pays you, and not the appreciation. Appreciation and cash flow, in my opinion, are the cherry on top of the sundae. Everything we discussed today is all the ice cream and the fruit and the whipped cream and the nuts. The sundae, or at least the cherry, is the appreciation and the cash flow. And cash flow is a lot more achievable because you can gauge that better. You can decide that better than you can ever decide appreciation. It's very rare that a person can call appreciation accurately. Yeah. You can call cash flow with fair accuracy.
Awesome. Love it. Thanks for sharing.
Not a problem. I appreciate you guys asking and letting me on here.
We appreciate your time, man, and your insight. I feel like I just took a master's class in finance.
Well, it's taking me 20-some years to come to these conclusions and asking a lot of questions.
Go ahead. I know exactly what you're going to say.
Do you? No, you don't. I was gonna give Anthony a hard time because I can't believe you called him the mortgage guy. So as he said that, I wrote down probably 5 names that I would call you prior to the mortgage guy. One of them being an economist, a wealth management mindset,
a for-hire CFO, an author, and also then a lender. That's how I describe Aaron Chapman.
Right on. Well, bald bearded redneck is all I call me.
Well, I'm sorry. Go ahead, Aaron.
Well, I have been labeled the conventional mortgage guy. And of course, the bald bearded bastard in black. But today I'm not in any of my black because I'm actually in my own my media T-shirt for my media company. I'll share real quick the. Actually, you guys may just see my you can see on my share screen again. Some bitches.
Yeah, please.
I'll show you the back. This is the logo for my. Can you see that?
Yeah.
So my media organization, the Silverback Gorilla on Coke, because that's ultimately how I go about my business. I think that's how everybody needs to go about their life. They need to decide how they're going to go about their stuff and then take off for that after that with the ferocity of a silverback on Coke. That's how I've gone over my business, my life. When you think about the silverback, he's got the dexterity. There actually is compromise within. There's education within the truth. It's really an interesting animal that you're dealing with there, but also has some of the most. Is very aware of his surroundings, but is also very ferocious. So that's why I go about things the way I do. That's why I can do 100 transactions a month. That's why I can continue to do the podcast and the media stuff here. I can write 4 books. I'll get you guys a link for Amazon.
Nice.
And they're big books, guys, 30 pages a piece. Because I think, we talked about the book number 3, Quit Jerking Off. The initiative is the Quit Jerking Off initiative. If I wrote 100 pages, I'd be jerking people off with a lot of the words. So I stuck with going into the topic, diving deep and getting out. So 30 pages or less. I have 3 more with my editor. I'll have a total of 13 done. The other thing that I'm encouraging a lot of people to do is get this. If you go on Amazon, if you do a search for the QJO initiative, as in the Quit Jerking Off initiative, you can find my 4 books and also order the Master Key System by Charles Hannell. The reason I recommend that is that changed my life. What it is it's a compilation of multiple, I believe, let me look at how many there is here. My memory is actually kicking my butt here on this, but it is a total of 24 week system here. So what it was is a correspondence course in 1910 where you'd write in, you pay for a letter. The letter comes into to you. You'd read the letter every single day for a week and do the mental exercise every day. Well, after 24 weeks, you have now trained your brain how to create. Now, if you ever listened to watched any of Napoleon Hill's video stuff they did way back in the 50s and 60s, or read his books, he references the master key. That's it. He did that correspondence course, as I understand.
Oh, awesome.
So start your morning routine with the Master Key System every day, reading 1 chapter a day. Don't jump ahead and do the exercise. Get your mind right. And between the books that I put out there is things that I've been able to things that have happened in my life by implementing things that I've learned by training my brain.
Perfect. Wow.
Aaron, thanks so much. And now I know the reason why you and I hit it off when we first met, because I too have often been described as a silverback gorilla.
Okay. You're missing the beard.
Self-described.
Awesome, Aaron, man. Thanks again for coming on here again. And as far, man, I'm still lost for words, but you are just a wealth of knowledge, and you say it like it is, and it's very refreshing. So thanks again for coming on our podcast again.
Well, thank you guys. I appreciate you allowing me back on, and hopefully there's a 3rd round.
Absolutely. Look forward to having you back. Thanks, Aaron.
Thank you.
Thanks for listening, and be sure to subscribe so you don't miss out on the next episode. Also, check out our website, infinitewealthconsultants.com, to find our podcast along with other additional resources.